going on, everyone? Lilith here. So I'll be sharing my investing plan in 2022 to make $100 a day in passive income. And after this video, you'll have the blueprint for exactly how you can do it too. So with that, we'll get straight into it. We'll be looking at two views. The first one is going to be the base case of a certain portfolio amount, exactly how it's allocated, what we expect to get back, and how much income are we looking at. And then from there, exactly how much we need to actually hit some type of target, and specifically speaking, our $100 a day target in passive income. At the top, you got portfolio total. I used $10,000 arbitrarily here to walk through our example. And so with that, we got the actual type of investment, what type of return I expect from that investment, portfolio allocation in terms of the percentage of that investment, a part of the whole portfolio, the dollar amount in terms of the portfolio allocation itself, so 20% of 10,000 being $2,000. You got the return that would be in terms of the whole year, and then the actual daily income. So essentially what this return is divided by 365 days. And so on average, what does that look like? Starting off, we got the stock market and dividends. So you got a return of 2.3% here. Now this 2.3%, it's a current real portfolio that I have, and that's the yield on cost today. And over time, I expect it to hopefully increase to 3%, 4%, 5% in terms of the whole dividend growth investing portfolio as a whole. At the same time, appreciation for some stocks can also be there, so the portfolio in the back end can grow. But the focus of this tracker slash my investing plan at this time is to figure out from a passive income standpoint, what are we really looking at? And so from dividends, you may not get a lot of money up front, but in the back end, there can be growth in terms of your portfolio. And in the future, your income can not just be stable, but it can actually outpace inflation and give you more reward overall for you to have that income to spend, and then know that, hey, from a stability standpoint, every quarter when that next dividend is issued, or every month, depending on what type of stock you have money consistently coming in, especially depending if you have a lot of holdings, you'll get a lot more payments as well. So that's kind of the rationale behind dividends over here. And so moving on, let's look at stock market options as well as cryptocurrency options. Right off the bat, 24%, I get it. To have this as a sustainable every single year, compounding year over year over year, it doesn't take a genius to realize if you can do that year over year, you yourself maybe are a genius. But the point is, the way I have it planned out, whether it's a cryptocurrency or the stock market, I'll leave a couple examples at the end of the video. Feel free to take a look. But really, it's still passive to me because in terms of options, you don't need to look every day. I happen to do it, but at the same time, you can just kind of say, hey, sell a contract for a month out or 3 months out, and you're getting X amount of premium today as a guaranteed return. And depending on the underlying asset, hopefully it can even appreciate even more. So in terms of income, 24%, it's still not very easy to do, but at the same time, in the back end, we're also assuming that the asset at least holds its value and hopefully can increase too, because you can definitely get more than 24% premium per year from options in stock market or cryptocurrency. But is your underlying asset really going to survive, or is it going to go down more than 24% where, yeah, you got the money today, but did it really matter in the end of the day? So just wanted to put that out here and kind of the rationale. And so from there, you got cryptocurrency stablecoin interest, and I labeled it as cash because basically it's as if having cash in the bank, you're losing money to inflation if you leave it in a savings account. And at the same time, if you get, let's say, 1% on your savings, that's great. But with inflation being 2 to 3%, maybe isn't the best option or location to put your money and stash it away. So stablecoins, USDC, GUSD, they're a type of stablecoins where they keep their one-to-one par value with the US dollar, but they just happen to be in coin form. And so if you're getting 8% interest on some platforms, you can get 9%, 10%, 11, 12, etc. But I just put it 8 over here just to kind of get this out of the way. And so daily income on 10,000, yeah, it's 22 cents. But at the same time, 8% on your cash, risk-free, quote unquote, is definitely almost unbeatable, especially given the fact that 7 to 8% is what, adjusted for inflation, is the S&P's return year over year over year over the last 100 years. And finally, speculative investment. I have a 0% return here, but if you look at the portfolio allocation, it's 10% with a dollar amount of $1,000. Now, the reason I put it as 0%, it's kind of this small yet huge kind of impact it made in my investing strategy as a whole. And it was that you can be as conservative as you want. You can have 100% of your portfolio into a dividend growth investing portfolio, or purely into, just an example, into some arbitrary FANG stock, Facebook, Amazon, Apple, Netflix, Google, Facebook, aka Meta, etc. The point here being that for me with speculation, if 10% of your portfolio is, let's say, into something that can go 10x, then believe it or not, from a mathematical perspective, that 10%, 10xing means that your 100% portfolio value, if 10% of that 10x you just doubled your whole portfolio as a whole. Now, what I expect, again, it's zero in terms of its expected return, But hey, even if it matches on par, yeah, it's tracking, it's, 0%, you still lose value to inflation. But the concept is the upper potential, in my opinion, is worth it, especially given how I've structured the rest of this 90% of the portfolio overall. So in a portfolio of $10,000 over here, you got a total. And specifically speaking, our return 1 year later, we're looking at $1,566 even. And daily income wise, if you divide it by 365, that's $4.29 per day. So how that looks for other numbers, such as $10 a day or $100 a day, which is our goal, this is what it's going to look like. So right over here is what we just went over, these lighter blue cells. And over here, DIG, it stands for daily income goal. What this is really saying is amount needed for $10 daily, $100 daily, and 100K if you're looking at that annually. These are basically the specific numbers, and this percentage return over here, naturally you can adjust this, but these are the actual dollar values to get there. And what we see over here, so $10 times 365 days is 3650, 36500, and 100K. And so again over here, what we can track is, hey, daily income goal total of $10. Basically, again, the same return, you can kind of see it. But the point here is this being the portfolio amount total. And so this is kind of the point I want to bring home, where the portfolio amount for that $10 a day is $23,307.79 based on how I expect the returns to be and depending on the division of the actual portfolio in terms of its allocation. And so if you want $100 daily, aka 36,500, then you're looking at 233K and change, and naturally 100K, 638K and change. And I get it. At the same time, if you have this type of portfolio amount, can you get this actual income? Yes, you can. Is it sustainable in the long term? What if 8% interest rates 5 years from now on stablecoins don't exist anymore? Then naturally that can be a downfall, which this portfolio would need to be reallocated or rebalanced to kind of get that target of where we're trying to go in terms of our daily income goal, if that's the driving factor. A couple points I want to include here are that, for example, credit cards, you get reward points when you spend on certain type of credit cards. And so the assumption here is that, hey, those reward points may be used for free travel or basically replacing what cash I would have spent for something else. And so a part of my investment strategy, I guess, is instead of using cash and burning it as is for X amount of travel, kind of hoping to use credit card points and miles to replace that cash that would be going. So at least cash is being invested today and it's working constantly, aka your dollar's working for you. Another point is leverage, where it's basically you're able to borrow against your assets, whether it's stock market or cryptocurrency. Maybe if you heard the term margin. And so there's more detail, I'll put it up here. But basically that can increase your actual potential gain, and it can also magnify your losses. So it depends how you use margin and if it comes into your investing strategy. I didn't account for it over here just because this is table stakes. Let's say there's no margin or you're just not capable to, or whatever platform, exchange, or brokerage you're using, for whatever reason, if you're not able to get that, what does it look like just if you had all cash in a portfolio without taking on every leverage, is basically what the case is of what we went over. Thanks for coming to the end. Bitcoin is trading at 46K and change, so if we round it up to 50K, for example, you would 360 days till expiry with an option contract at expiration of December 30th, 2022, $50,000 strike price. Premium is $12,250 in terms of the bid, and the ask is a bit more. But even if you get as low as the bid, right? If you look at the actual math behind the whole situation, you're looking at $12,250 over here divided by $50,000, which is 24.5% in terms of premium up front. And of course, that's, you still get a few extra thousand if it executes, where that's spread between 50K and 46K and change. But just a quick example of Bitcoin and options, just an example. Ethereum sitting at 3,700 over here, and in terms of your actual 2022, same expiration as that Bitcoin contract. Basically, if you look at the math at $4,000, and in terms of premium 950, if you do that math, again, 950 on the lower end divided by $4,000 is 23.75%. So you're still getting all of this upfront if you choose to go along this type of path to get that in terms of options and premium upfront. The stock market example, just a quick example, we got AMD stock over here. So 150 and 97 cents is the actual share price right now. And if you sold the contract for January 20, 2023, you got 27.93 in premium and 155 in terms of your strike. So just plugging in those numbers, you got 27.93 premium divided by what we're paying today, so 18.5% upfront. But due to the actual execution price of 155, if we do that same type of math, where we're saying instead of 27.93, but that total profit potential of 32.93, and if we divide that, for example, by our same cost basis of 150 and 97 cents, then basically what that percentage on the other hand is going to look like is 21.8%. And so 2% a month, it's still shy over here of that amount. But at the same time, this is if you actually sell it and just don't touch it for the whole year. And so there's still opportunity for you to buy and sell and make a little more money in between. But with that, thanks for coming to the true end.